Welcome back to another episode of the Beginner Day Trading YouTube channel. I truly appreciate you guys for being here. If you guys could, please hit that thumbs up as we continue to grow the channel. Thank you guys in advance. So, we are going to be talking about understanding options in the Robinhood brokerage app. And so, I have the desktop open here, and there's a lot of things you're going to need to understand as it pertains to trading options across the board. But more specifically, we're going to be talking about trading options in Robinhood. Now, I have SPY open, and so the SPY is an ETF that tracks the S&P 500, but there is a lot of liquidity that comes in and out of this particular ETF. So you'll find that a lot of traders use the SPY. So what we're going to do is we're going to click on Trade SPY Options here, and you'll notice that the option chain is going to appear. Now, when it comes to trading options, you're going to have calls and you're going to have puts. Calls simply mean you're betting that the stock is going to go up or ETF. A put means you're betting that the stock or ETF is going to come down. And so there's a variety of different ways you can use calls and puts. You can use them in a bullish manner, meaning you think the market's going to go up, or you can use them in a bearish manner uh, because you believe the market's going to come down. You've done your due diligence, you've studied the charts, and you have an explanation on why you think a stock will go a certain way. Now, let's talk about calls, okay? So when you're buying a call, for example, let's say we want to uh, buy a call at the strike price. So you can see strike prices here at $538. Okay, you can see the current price is $538.73. And so any option, I'm sorry, above this red line is going to be called out of the money. Okay. Any option below this red line is going to be in the money. Okay. So that's simply what that means. We can break that down a little bit further, but in a nutshell, that's what it means. So if you, for example, bought a call at 540, you would expect this to eventually come to in the money, meaning you're gonna make profit in the extent that you make this profit before it starts to decay in value. And we'll get a little bit deeper into that. Now, let's go back to our strike price, 538. Okay. So if we're going to say, hey, we think it's going to go up, you see it's $4.83, essentially meaning it's going to cost you $483. And you can see our expiration here is September 10th, and that means it's going to expire in 2 days. So if you click here, you notice on the right, um, it shows you, let me zoom this out a little bit. There we go. So you notice on the right, it shows you exactly what happens here. If this thing continues to go up, guess what? You can make $300, $600, just depending on how aggressive it moves. Okay. Now, if it goes down, the max you could lose is that $483. But when you're in these positions, you want to make sure you set a stop loss. Okay, so we'll talk about those as well. So stop losses are very important. Now, if you click on this chain, the $58, right? So we'll click $58, and notice down at the bottom you can see the Greeks. Okay, the delta means for every dollar that the SPY goes up, you would make $62. Now notice it's stated here, for every day that you hold this contract, you're gonna lose $78 in value by default. Okay, so theta is essentially time decay. Delta is simply telling you what happens if if the particular stock or ETF would have moved to the upside. If it would have moved to the upside, you're gonna make $62. If it goes down, you're gonna lose $62. Okay. And so these are some of the most important aspects of getting into these option plays. Okay. Now we could talk about Gamma and Vega, but those are a little bit, I mean, more advanced to a degree. So for me, I think the most common ones to know are just Theta and Delta. Now you notice when you're dealing with an expiration that is a couple of days, the Theta and the Delta are going to move and change very quickly. So what happens is a lot of people will give themselves more times, right? So maybe they go a week out, maybe they go a two weeks out, and let's show you what that looks like here. So for example, my rule of thumb is if I know I'm gonna hold something for a day, I'll go like a week out. So I would go with a strike price like 8 days. If I was gonna hold for 5 days, then I would go like 50 days out to give me a little bit more wiggle room. And maybe you need that time to really decide what you want to do and see how the market is going to react according to what you originally thought it would, right? So sometimes you want to leave yourself some time. Now, let's talk about this theta thing a little bit more in depth. So again, by default, you're gonna lose this $78 um, per day by default. So notice the strike price is 538, okay, and it costs $483. So if we go 2 days out for the same strike price, all right. So let's go to September 4th. And now let's scroll down to 538. Watch how more expensive it is, okay? So you can see it's almost $200 more. And this is how you'll know if this data more or less is accurate. So again, this is essentially saying in 2 days, this thing is going to be $120 less than what it is right now. And you kind of have proof of that if you go back to the original options change we looked at. Okay. So see how it's nearly $200 less, kind of showing you the accuracy there. Now, what happens when you buy a call is essentially saying you are given the right to borrow 100 shares at a discount. Okay. And so that's essentially what that means. Instead of buying 100 shares outright, you have control of 100 shares. And that's to the extent that this thing is going to keep moving to the upside if that's the direction that you foresee it going. Okay. Now, let's talk about selling calls. So if I go to, I'm going to take this out here. If I go to sell a call, what that means is you're going to have to own 100 shares of a stock in order to sell a call. Okay. So let's say I own 100 shares of SPY and I say, you know what? I don't think this stock is going to go past $545 within this next 2 days. Okay. And so this will come up here. And if it doesn't go past $545, guess what? You could get to collect $145. Now, if it goes above $545, now your premium is going to get start to get ate up. And let's say expiration comes, now you're going to be forced to share your your shares, but you will still be in profit minus the premium that's going to be deducted from the movement going past what your strike price is, which is $45, if you hold it to expiration. Now you can always buy your way out of the position if you want to get out. So remember, if we're selling a call, the way that you would close your position is you're going to have to buy yourself out, and you're going to have the amount of capital in your brokerage to buy yourself out, if that makes sense. So you could even get out early. Let's say it's a day before expiration, you're in profit, you want to get out, you still can buy your way out. Okay. So I know that's a little bit confusing. So the important thing here is to understand that when you are selling a call, you're essentially saying that you don't think that the stock is going to, or ETF is going to go past whatever price that you have purchased by this expiration date. Okay. So this is very, very important to know. Now, let's go into something a little bit more advanced, right? So there is something called a call credit spread. Okay. So basically, let's say you don't have the amount of capital and you want to do something similar to this. Now what you would do is you have this click here. Remember, to do this, you're going to have a margin account. So if you don't have a margin account, make sure you apply for that through Robinhood, and you'll be able to do some of the more complex options that I'm going to show you here. Okay. So now let's say that you want to do a call credit spread. So what I would do is I'm going to change this to buy. Okay. And so, sorry, that's a call debit spread. So I'm going to sell, I'm sorry, I'm going to buy a call above the one that I'm selling. Okay. So this is called a call credit spread. Okay. And so essentially, what you're using is $70 of capital, which you can see here. So essentially, you're using $70 of your capital in order to make $30. Okay. So when you look at this graph here, if this thing goes, let me scroll below 545, you'll make $30 by expiration. If it goes the opposite way and it starts to go above that, now your premium is going to get ate up and you could potentially lose $70 by expiration. But again, you can still buy your way out of it. Okay. So very, very important to know. Now, let's talk about a call debit spread. So you can change this. And so you're going to have a sell call above the buy. Okay. And so it would look something like this. And essentially, what this is saying is the opposite way. So if the stock were to go above 545, you could potentially make $66. But if it goes the opposite way, it goes below, now you could lose $34. So you can see that the balance is different between the call debit spread and the call credit spread. Now, one of the things I like to say about the call debit spread is the bid and the ask, right? So if I click here, for example, you'll see bid and the ask below. So what tends to happen with the call debit spreads is you'll notice the bid and the ask will be wide, meaning you're probably not going to make the amount that you could potentially, and I've seen this a lot. So you'll notice they'll play a lot of games between the bid and the ask, and they're going to use that to advantage to make a little bit more money out of you. And the thing about the debit spreads is you want to get out of those before expiration, uh, otherwise, you're gonna get ate up. So just be careful with that. Okay. So again, in a nutshell, guys, this is kind of talking about the things you can do with calls. Okay. Now let's talk about the put side of things. Okay. And we can get way more advanced with these different option plays. I know, but we'll try to keep things simple. So if you want to play puts, right, that's saying you think that the stock is going to come down, okay? And essentially the same concept applies when as it pertains to your delta, right? Delta, this is meaning that if the stock moves one way or another, a dollar for every dollar, you can make or lose $39. But look at the theta on this one. This one's moving a little bit quicker than the call, right? So this means that for every day you hold this put, it's gonna by default lose $82 in value. Okay. Now, before we get into this, I want to show you guys something. Let's say, and this is just in regards to this theta and delta. Let's go out a little bit further. Let's go close to a year out. Okay. Now, let's bring this thing down to 538, and I want to show you guys something really quick. Okay. So let's just look at 535, for example. Let's look at the theta. Look at the theta when you go a little bit further out. So when you go further out, you give yourself a lot more time for a play to develop. But look at the price here. The price is much more expensive, but look at that theta. This theta is essentially saying for every day you hold this particular um, for this particular option contract, you're only going to lose this 0.03, which is essentially $3 a day. Now, if this thing keeps coming down, then obviously the theta is not going to be important, right? But these are the things you have to pay attention to. But let's look at the delta now. For every dollar move it goes up or down, you're gonna make or lose $38, right? So this theta and this delta is very important. So now let's go back here. Let's go back to September 10th and let's continue what we were talking about. Now, when you buy a put, so let's say we're gonna buy this put, we say, hey, we think this thing is gonna come down. Look at this here. So if it comes down, there's an infinite amount of money you can make here. Maybe you make $800, $980. But remember, that delta is going to be moving very quickly because this thing expires in in 2 days, right? So look at this. Look at this data. Keep pay attention to that. It's going to by default lose $83 every day that it's held. So when you get into these plays, you want to have your plan established. If you start to see some green, just go ahead and take it. Now, I can't give you guys financial advice. I guess I'm talking to myself, but listen, take the green if you got it. Now, essentially, if you were to get into this put, if you were buying this put, you're gonna potentially make a couple $100 if you know if it's really a catastrophic day and the market is tanking, maybe you make $1,000, $2,000, who knows? But remember, you're using $272 of collateral, so you want to make sure you use a stop loss because you don't want to get caught holding the bag, and now you're trying to fight your way back, average your way out, and you're steady losing money due to this time decay. So remember that. So execute your plan, have a stop loss, don't sit on them too long, or have an expiration date that goes out a little bit further that will give you enough time to let a play develop. Okay. And so there is something called rolling the option. We'll get into that later. So if an option doesn't move in a way you would like it to, you can go ahead and roll your option out to a later date until the play develops in a way that you necessarily will want it to. Okay. Now, let's talk about selling puts. So I'm going to take that off. And let's say I don't see this stock going below, or ETF, I'm sorry, going below 534 over the next 2 days. Now, it's a little bit different with this one because when you're selling a put, you're essentially saying, I would like to buy this stock below this particular price, right? So if the stock were to go below this price, then at expiration, you would be forced to buy. So, for example, right now, this stock is $538. If by expiration it's at $530, now you're going to be forced to buy these shares, right? But if it goes up, you can see here you have the potential of making $149 premium if this thing goes to the upside, right? So if it goes to 540, 542, 545 at expiration, then you're going to make money off this premium. But essentially, you'll see people selling puts really to make a weekly income, or if it's something they want to get into for a cheaper price, right? So again, if you're going to be in that position where you buy, I'm sorry, sell a put, and it by expiration it goes to 530. Remember, you're going to lose this premium, but you're going to get the stock at that price, whatever the price is at expiration. Now, again, you can always get out of this. So if you buy here and this stock goes to the upside, you can buy your way out and take your profit before expiration. Remember that you can always take your profit before expiration. Now, let's talk about put credit spread. So now I'm changing the chain to a buy. So I'm gonna keep this sell here. I'm gonna do a buy right here. And notice there's a put credit spread. So when you're doing a put credit spread, you're essentially saying, I don't think this stock really is going to be below 534. I think it's going to go up, meaning I'm bullish. I think it's going to go up. And so you notice here, if this thing is above 545, guess what? You can make up to $23. But if it goes below 534, it's going to start to eat your premium. And then if you go below 533, that premium starts to speed up as it pertains to losing value. So you could potentially lose $77, but you want to buy yourself out of this if it starts to go the opposite way. But sometimes you got to be patient and let these things play out. I learned that early on. You don't have to freak out. Just do little bits of these types of scenarios at a time, and things a lot of times will work out. Okay. Now let's talk about put debit spread. So same type of concept with the call debit spreads. You want to get out of these way before expiration because if not, they're gonna take your money. So again, this would be the opposite aspect. So if this thing were to go up, you would could lose $25. But if it were to go down, you could potentially make $75. But the bid and ask is going to be far spread apart, and it's probably not going to work in your favor. Okay, so why would you do uh, uh, put credit spread? Going back to the credit spread, I'm sorry, you would do this if you were a person that did not have the capital necessarily to sell a put outright. So this is basically a cheaper way to make a premium if you don't have $50,000 to just sell a put outright on the ticker symbol SPY, right? Now remember, when you're getting into these different credit spreads and debit spreads, you can do multiple contracts, right? You could do 100, for example, if you got, $7,000 of collateral, you could potentially make 2,300 dollars. Let's say, you know what? I got 70 grand, right? I could potentially make $22,000 if I were to do a put credit spread. So in a nutshell, you know, there's a variety of ways that you guys can kind of work this. Okay. Now, what I'm going to do is, and this is something a little bit more advanced too. We'll talk about some of this at a later date, but I want to go back and show you guys if you're already, let's say you're already in a you're in a play, right? So let's say you're in a single call. You got one call, you bought one call, you think a stock is going up, right? Notice once you have your order open, you could go back in and you could go set stop limit order, which is here. Okay. So now let's say you bought, oh, let me see. Let's say you bought a contract for $480, right? So now you come in and you could put a stop loss. Like let's say if it's worth 480, I'm not willing to lose more than $20 on this play, right? So you would do something like this: 460, and then you could do like 455. That will give you like a spread in case things move a lot quicker. Because what happens if you're going to be selling something, there has to be a buyer for it. And in the environment that we're in, these stocks and ETFs moves very quickly, right? And so another thing you want to make sure is whatever contract amount of contracts, this would say contract, for example. If you have 10 contracts, make sure you put 10 in there. Because if you don't, it's only going to sell one. So essentially, when you go in and you set your stop limit order, make sure you have a little bit of space in between because you're gonna have to have a buyer if someone doesn't buy at four $160 and this thing quickly goes to 450 or 455, you want to get out guaranteed. Put a little bit of distance between your stop loss. Okay. Now, overall, guys, these are the basics of options inside of Robinhood. I'll do a part two on this and get a little bit more advanced with some, more advanced strategies you guys could use. But for now, this basically what all you would, it's all you would really need, honestly. Okay. So give us a thumbs up, please. Share the video. Let me know what kind of videos you would like on this platform. Until next time, guys, we're out. Peace.